Good afternoon, everybody. Uneducated Economist here. So I want to see if I can get you guys' help on something. Now, I have tried to track down some of this information. I was hoping somebody had already done like an article or a video, and maybe they haven't. I just haven't found it. But I really want to know what's going on right now with the mortgage-backed securities and the Fed's purchases. Like, I want to know how much of the market the Fed is purchasing right now, like last week or the week before. If somebody could figure that out, like how big is the issuance of mortgage-backed securities, and of that portion of issuance, how much is the Fed buying? That's the question that I want to know. And I looked around for a couple of hours yesterday, off and on. I would go and Google it again. And I couldn't seem to find either an article or a video or even the information in general, just trying to find out like mortgage-backed security issuance and then how much the Fed is buying. Because this is the question that I have, is that if the Federal Reserve is purchasing $40 billion a month, and this is something we have talked about before, but it's really eating at me, so this is why I'm making the video, because I want you guys' help in this, is that if the Federal Reserve is purchasing $40 billion worth of these mortgage-backed securities every single month, like they're set at that. This is how much we're purchasing. But yet right now, we're seeing the sales fall in home sales, right? Not the pricing, just the amount of homes that are being sold, right? That's dropping. The amount of mortgages being issued, that's coming down. Either through refinance or just the sale of a home, there's not as many of them. There can't be. And so if there's less mortgages being written, then there's less mortgage-backed securities being issued. And if there's less mortgage-backed securities being issued, then the Fed must be buying an ever-increasing amount of that portion of the pool. You see where I'm getting at here, guys? Now, if you think about this for just a minute, if the Fed, like, say that we're buying like 5% of all the mortgage-backed securities, and they said, hey, we're a buyer of mortgage-backed securities, and this $40 billion worth ends up being somewhere around 5% of the mortgage-backed security market. Not a big deal, really. But if it goes up to like, say, 20, 30, 50% of the mortgage-backed security market, then the Federal Reserve is pretty much the only buyer. Like, if they weren't there, the free market wouldn't be there either. And now what I mean by that is that a lot of investors are willing to buy into these mortgage-backed securities knowing that the Federal Reserve is there, knowing that these guys are a purchaser of mortgage-backed securities. There's no way that there won't be a buyer, because the Fed has already said we are a buyer of $40 billion a month. So now the idea that interest rates on home loans are going to go up during this time doesn't seem as likely if the Federal Reserve is buying as much in the mortgage-backed security market as I'm thinking they would be. So like typically as the 10-year interest rates rise, then so does like all loans out there, mortgages included. And the reason is that an investor can either loan money to the U.S. government, the ultra safe, guaranteed to pay, no worry about default, or they can take on risk going someplace else. And now the mortgage-backed security, the equivalent of the 10-year Treasury, is just really a few basis points higher than the U.S. Treasury is right now. So they're really not that far away. The spread between the two is shrinking. At some point, the investor is going to say, why are we taking risk buying mortgage-backed securities when we can just buy the U.S. Treasury instead? You see, this is what a logical investor would think. I would think anyway. Maybe, I don't know. I mean, what do I know? I'm not an investor. But I'm just assuming this is probably what the average investor would assume, is that, why would I want to buy a mortgage-backed security, take on risk of something defaulting and them not paying, even though like a lot of these things are guaranteed by, Fannie Mae and all that other stuff. Regardless, right? You think mortgage-backed security is definitely going to be a riskier place to go than the U.S. Treasury is. But yet the spreads on these things are getting closer and closer. So now at some point, the Federal Reserve is going to be like, okay, we're obviously buying too much of these things. We're distorting the market, which is happening. And we're going to have to reverse course. Meaning, instead of buying $40 billion a month, maybe we can only buy 35 or 20 billion, or Maybe we won't buy mortgage-backed securities. That would definitely change the perception of the entire market. Everybody would be like, oh man, the Fed's not in the game no more, I'm out. And they start dumping it. So now the Fed might be stuck in this position. And this is what, one of the things that I had suggested in the past video, is that the Fed is now like, crap, how do we get out of this mortgage-backed security market without like freaking the markets out? You can't. See, they're using credible threats as their main tool. And credible threats work both ways. See, it's not an actual tool. Their threat is to put the perception out there for people to buy into. See, they put it out there saying, okay, we're going to be the ones out here doing this thing, and then the whole market goes, hey, look at what the Fed is doing, let's react to that. And that's what happened like with the corporate debt back in the, when the special purpose vehicles were created, those lending facilities. They didn't buy hardly any corporate debt. The news out there said the Federal Reserve was going to be buying corporate debt. Like there was a lot of people talking about this, all this corporate debt that the Federal Reserve was going to be buying into. They hardly bought any. Just the mere idea that they were going to be buying it but encouraged the market to go out there and buy the corporate debt ahead of them, trying to front run them. When it was all said and done, the Fed was just like, hey, we really didn't have to do anything. Just the idea of us buying into corporate debt was enough to get the markets to go out and do it for us. So now that very same perception can work in reverse. See, they have the credible threat going that they will be there with the $40 billion a month. But the moment that they change that and they say, hey, we're not going to be there with $40 billion a month, the markets are going to be like, oh man, the Fed is backing out. The Fed is backing away. They can't do it. That would like start unwinding and undoing everything that they have been trying to build here for the last year. They cannot say, hey, we're going to cut back on our mortgage-backed security purchases. If they don't, and the sales continue to drop like they are, like the amount of homes being sold because of the lack of inventory and the lack of homes being built, then the Federal Reserve is going to be buying ever more increasing amounts of the mortgage-backed security market, causing the problem to get worse. Interest rates going down and the prices going up on those mortgage-backed securities, giving people ever increasing amounts of opportunity to buy houses with very low interest rate mortgages. You see, they're stuck. They're absolutely stuck in this. And for somebody to say like, no, this isn't a bubble, this is average, this is like a typical market, is beyond me. I mean, if the Federal Reserve was not there doing this right now with this $40 billion worth of mortgage-backed securities purchases, while everybody is demanding a house, if they didn't have this going on right now, where do you think things would be? What's going to happen? This is the question that I'm asking. What's going to happen when the Federal Reserve decides that they are going to change their position on the mortgage-backed security purchases? If they don't, how much of the market is the Federal Reserve going to end up purchasing if they don't change their stance? Either way, it seems like a bad deal. All right, Uneducated Economist, you guys let me know.